Okay, so welcome to yet another discussion of a question from the exam kit of AFM. This is a question focused on adjusted present value. And let me tell you something, this question is not different as compared to the kind of questions that we have seen in the past. This is a past examination question and it's a good one. It will help you to revise your basics of adjusted present value properly. As always, you should always read the requirement first. Discuss the adjusted present value for the investment on the basis that it is financed by subsidized loan and conclude whether the project should be accepted or not. Show all relevant calculations. Basically, what they want you to do here is calculate APV. Now, to calculate APV, let's first of all understand that we'll need the base case NPV, regular NPV calculation, and then we'll also need to calculate the APV after considering the financing side effects. Okay, now Tippletine company is based, if you want, I'll increase the magnification a little, no problem there. Tippletine company is based in Valiland. It is listed on Valiland's stock exchange, but only has a small number of shareholders. Its directors collectively own 45% of the equity share capital. Tippletine company's growth has been based on the manufacture of household electrical goods. However, the directors have taken a strategic decision to diversify operations and to make a major investment in facilities for the manufacture of office equipment. The new investment is being appraised over a 4-year time horizon. Revenues from the new investment are uncertain, and Tippletine Company's finance director has prepared what she regards as cautious forecast. These predicted operating cash flows are as follows. Net operating cash flows before marketing cost, then the marketing cost. The new investment will require an immediate expenditure on facilities of 30.6 million. Tax allowable depreciation will be available on the new investment at an annual rate of 25%, reducing balance. Okay. It can be assumed that there will either be a balancing allowance or charge in the final year of investment appraisal. The finance director believes the facilities will remain viable after 4 years and therefore a realizable value of 13.5 million can be assumed at the end of the appraisal period. Okay. So you know now you have the residual value of the project also. The new facilities will also require an immediate initial investment in working capital of 3 million. Working capital requirements will increase by the rate of inflation for the next 3 years, and any working capital at the start of year 4 will be assumed to be released at the end of the appraisal period. Tippletine Company pays tax at an annual rate of 30%. Tax is payable with a year's time delay. That is, tax payment is in arrears. Make a note of that fact. Tax is payable with a year's time delay. Any tax losses on the investment can be assumed to be carried forward. So losses have been carried forward and written off against future profits. Okay. Predicted inflation rates are as follows. Year 1, 2, 3, and 4, 8, 6, 5, and 4 is the inflation rate. Tippletine Company is considering two choices for financing all of the 30.6 million needed for the initial investment in the facilities. A subsidized loan from a government loan scheme with the loan repayable at the end of 4 years. Issue cost of 4% of gross finance would be payable. Interest would be payable at a rate of 30 basis points below the risk-free rate of 2.5%. In order to obtain the loan scheme, Tippletine Company would have to fulfill various conditions, including locating the facilities in a remote part of Valiland where unemployment is high. So here, what is the actual rate? 2.5 is the risk-free rate, and this is a cheap loan which you will get at 30 basis points below the risk-free rate of 2.5%. Okay. Now, convertible loan notes with the subscribers for the notes, including some of Tippletine Company's directors. The loan notes would have issue cost of 4% of gross finance. If not converted, the loan notes would be redeemed in 6 years' time. Interest would be payable at 5%, which is Tippletine Company's normal cost of borrowing. Conversions would take place at an effective rate of 2.75 per share. However, the loan note holders could enforce redemption at any time from the start of year 3. If Tippletine Company's share price fell below 1.5 per share, Tippletine Company's current share price is 2.20 per share. ठीक है, loan note holders could enforce redemption at any time from the start of year 3 if Tippletine Company's share price fell below 1.5. So if the price falls below this number, then they could force the company to go for a redemption. Right now, the share price is 2.2. Issue cost for subsidized loan and convertible loan notes would be paid out of available cash reserves. This point is important. So issue cost would be paid out of available cash reserves. This has some implication in your answer. Issue costs are not allowable as a tax deductible expense. What is the implication? We'll get to that. In initial discussions, the majority of the board favored using the subsidized loan. The appraisal of the investment should be prepared on the basis that this method of finance will be used. However, the chair argued strongly in favor of convertible loan notes. As in, his view, operating cost would be lower if Tippletine Company does not have to fulfill the conditions laid down by the government of Valiland. Tippletine Company's finance director is skeptical, however, about whether the other shareholders would approve the issue of convertible loan notes on the terms suggested. The directors will decide which method of finance to use at the next board meeting. See, this is majority of the board has favored the subsidized loan. So your calculation of APV should be considering that the company has gone in for a subsidized loan. Humabu's company is a large manufacturer of office equipment in Valiland. Humabu's company's geared cost of equity is estimated to be 10.5 and its pre-tax cost of debt is estimated to be 5.4. These estimates are based on a capital structure comprising 225 million of 6% irredeemable bonds trading at 107 per 100 and 125 million of $1 equity shares trading at 3.2 per share. Humabu's company also pays tax at an annual rate of 30% on its taxable profits. Calculate the APV. So for calculating APV, if you remember, the first thing we have to do is we have to calculate the base case NPV. And the base case NPV is always calculated assuming that the company is an all equity financed company. Okay, now for that, you will have to basically use cost of equity for the purposes of discounting. Okay, now, first of all, let's get down to calculation of net present value in the sense, let's calculate all the cash flows first, and then we'll need the all equity financed, we'll have to calculate the NPV assuming that the project is all equity financed, which means we cannot use WACC, we'll need the cost of equity for this particular project. Now, that is where the calculation gets a little tricky. I wouldn't say tricky, rather, they have given you some data here. What is that data? They have given you information about another company whose cost of equity is 10.5 and its pre-tax cost of debt is 5.4. These estimates are based on a capital structure comprising 225 million of 6% irredeemable bonds trading at 107, and they have given the capital structure. Basically, here again, they see, you don't have cost of equity of your company, but you have cost of equity of another company. Okay, now the cost of equity of another company is given to you. And but what kind of a company is this? If you observe, this is 10.5 is cost of equity. But Humabu's company is a geared company. It has some equity and it has some debt. Now, when you are calculating the base case NPV, you need to use the cost of equity for purposes of discounting. And this cost of equity has to be of an ungeared firm. Correct. This cost of equity has to be that of an ungeared firm. Now, when we are calculating cost of equity of an ungeared firm, we'll have to remove the impact of debt. Now, normally you de-gear the beta using one of the degearing formulas that we have learned. But there, if you remember, there are two approaches to calculating the cost of equity. And in this case, what we are going to do is we are going to we'll prepare our working notes here. The first working note is for calculation of cost of equity. Now pay attention. We need cost of equity of an ungeared firm. Now, Humabu's company is a large manufacturer of office equipment. We are also in a similar business. ठीक है? It wants to diversify and make a major investment in facilities for manufacturing of office equipment. So we want to enter the office equipment space, and here Humabu's company is already operating in that space. So we are using Humabu's company as the proxy company. Okay, so we look at Humabu's company, we understood that it is also in the same business. So we were tempted to use its cost of equity. We wanted to use 10.5% for the purposes of discounting, but then we realized that this is a geared company because there is debt in this company. We want ungeared cost of equity. So we'll have to de-gear the cost of equity. And how do we do that? We use M&M proposition 2 here, which is KE is equal to KEI plus 1 minus tax rate into KEI minus KEI minus KD into VD upon VE. Okay. Now, what is KEI? Cost of equity in an ungeared firm. KE is the cost of equity of a geared firm. VD is value of debt. VE is value of equity. So KE is cost of equity in a geared firm. Humabu's company is the proxy company. It is a geared company. Its cost of equity is 10.5. So 10.5 is equal to KEI plus 1 minus 30% into KEI, which is 10.5 minus other KEI we don't know, we know KE, sorry. This is KEI minus KD, which is 5.4 into VD upon VE. Now, what is value of debt? 6% irredeemable bonds trading at 107 per 100. The face value of the bonds is 225 million. So what is the market value of bonds? It is 225 into 107%. How much does that come down to? 225 into 107%. It comes to 240.75. And what is value of VE is value of equity. How exactly are we going to calculate that? $125 million one equity shares trading at 3.2. So market value of this is 125 into 3.20. 125 into 3.2, which is basically 400. Now, I have these two numbers with me. I'm going to substitute these in the formula. 240.75 upon 400. Now I'm sure you know how to do this mathematical jugglery. My KEI, that is cost of equity in the ungeared firm, comes to 9%. This is approximate value, which has been rounded off. So we are using Modigliani and Miller proposition 2 in order to calculate the cost of equity of an ungeared firm. This is one of those formulas which we don't use so frequently, but once we have that KEI with us, now other calculations are relatively easier. Okay, now if you observe right from the top, okay, they have given you net operating cash flows before marketing cost. They have given you marketing cost, and then they have given you the cost of the new investment that you are going to make, and tax saving on depreciation, and all of those points will have to be considered. Now we'll start preparing our regular statement of net present value here. So statement of net present value. To calculate NPV, you need three things: amount of cash flow, timing of cash flow, and the discounting factor to be used. Discounting factor, I think we have calculated just now. So we seem to be pretty sorted on that front. Now we only need the amount of cash flow. This is a 4-year project. So T0, T1, T2, T3, T4, and T5. Okay. Now let's start with the cash flows from the top. The first one is initial investment. How much is the amount of initial investment? 30.6 million. All these calculations are in thousands. So initial investment is an outflow at T0, 3,600. Okay, 30,600. I have converted that into thousands. Statement of net present value in $1,000. Just make sure that you specify the unit in which values are mentioned. Okay, after the initial investment, let us see what is operating cash flow before marketing cost. Operating cash flow before marketing cost. 2,000, 14,500, 15,225, and 15,834. 15,834. Okay, now from this we have to subtract the marketing cost. 9,000, 2,000, 2,000, 2,000. So minus 9,000 minus 2,000, we get the values. Now we'll get cash flow before tax. Okay. Cash flow before tax, B minus C. Fair enough. Now there will have to be a tax paid calculation that you do here. But observe one thing. Okay. Now in year one, you suffered a loss. What does the question say? The question says that loss has to be carried forward and written off against future profits from the investment. Now, whatever loss you have incurred, that loss has to be carried forward, and in the subsequent year, whenever there is a profit, you should adjust that loss against the profit and then pay tax only on the net amount. Now, profit is something that you will get after subtracting the amount of depreciation. So what I'm going to do here is I'm going to prepare a working note which is on calculation of profit and tax on profit. Now, particulars, 4 years. Okay. Year 1, year 2, year 3, year 4, year 5. Okay. So operating cash flow, marketing cost, then you will also subtract tax allowable, depreciation. You will arrive at operating profit. Okay. And then of course there will be adjustment of loss and then tax paid on that loss. Now let's understand how to calculate the amount of tax allowable depreciation. The question specifically mentions that tax allowable depreciation will be available on the new investment at an annual rate of 25%. Now this calculation I'm going to straight away copy from I have the calculation ready. I'll show you, of course, you also know how this calculation is done. This is working note 3, tax allowable depreciation. Okay, so Tax allowable depreciation is 25%, 30,600 into 25%. You have WDV of 22,950, another 25% depreciation, 17,213, another 25% depreciation. WDV at the start of year 4 is 12,909. Now, this particular item is sold for what value? This particular item is sold for a realizable value of 13.5 million. Written down value 12,909, sold for 13,500. So there will be a balancing charge on disposal, which is 591. Now here this tax allowable depreciation is something that I'm going to subtract. I have my operating cash flow figures for each of the years. Less marketing cost and tax allowable depreciation. In the last year, you don't have tax allowable depreciation, rather, you have a balancing charge. Now, what is my overall operating profit slash loss? If it's a negative figure, then it will be a loss. This is your year 1 to year 4 data. And the question very specifically points out to you in no uncertain terms that if you have incurred a loss, then that loss will be carried forward and adjusted in the next year. Okay, so let's adjust the loss. Loss of 14,650 taken to the next year, adjusted against the profit of second year 6762. After adjusting, see my total loss is 14,650. From that, I adjusted a loss of 6762. How much loss is still not adjusted after year 2? 7,888. So I will adjust minus 7,888 here, and then nothing of course to be adjusted in the last year. And what is now my taxable profit? Year 1, no profit. Year 2, I had a profit of 6762, but then I absorbed my loss and my taxable profit was 0. Same thing happens in year 3. My total profit was 8922, but I adjusted a loss of 7888. So I'm left with a taxable profit of 1034 and then 14,425. What is my tax at the rate of 30%? Tax at the rate of 30% is 1 year in arrears, by the way. So 310 here and 4327.5 here. Now this calculation is different and this is not something you would have expected straight away. So the reason for picking up this question was also this, that the adjustment of losses was a crucial step. And if you don't know how to do it, naturally you might end up making that mistake. So I have spent adequate amount of time discussing how exactly the amount is going to be adjusted. Now, you could have done multiple calculations here. You could have calculated tax on, you could have adjusted the loss here, then calculated tax, then again done tax saving adjustment. I simply summarized that into one step by calculating the tax on profit separately in a different working note. Because of the adjustment of losses thing, I had to be super careful. Okay. Now, E, tax on taxable profit. This is working note 2. Okay. So now we have the profit figures also for each of the years. Now, my machine is going to get disposed at the end of the project life. So disposal of machine is how much? 13,500 is the disposal of machine. Cool. Now, we have considered cash flows, marketing cost, initial expenditure, depreciation, or realizable value. New facilities will require an immediate initial investment in working capital of 3 million. Working capital requirements will increase by the rate of inflation for the next 3 years, and any working capital at the start of year 4 will be assumed to be released at the end of the appraisal period. Now, again, one of those typical working capital adjustments that you have to do. So, working note 4, working capital adjustment. Okay. Particulars, start of year 1, 2, 3, 4. Start of year 2, start of year 3, start of year 4. Okay, so let's write down working capital requirement 3000. Then at the start of year 1, then it increased by 8%. There was inflation of 8% in year 1. So at the start of second year, your working capital requirement was 3240. Then there was an inflation of 6%. This plus 6%. Okay. Then there was an inflation of 5% in year 3. So at the start of year 4, you had your total working capital requirement was 3606. So let's get the working capital flows. This will happen at the start of each year, and when project closes at end of year 4, there will be a release of working capital worth 3606. Okay, so let's write that down now. After disposal of machine, I'm writing down my working capital movement. And it gets released at the end of the 4th year. Okay, so working capital requirement has also been handled in working note 4. So just give that reference here, working note 4, and now you give the total cash flows. Okay, total cash flows are initial investment A plus D, that is cash flows before tax, minus E plus F minus plus G. Okay, so this this ठीक है. उसके बाद discounting factor at the rate of 9%, because that is, the rate that we have so painstakingly calculated. This will give me NPV, assuming that it is an all equity financed company. You get your present value. How do you get your present value? H into I. 33,600 into this thing. I will get my base case NPV. Okay, my base case NPV is going to be a total of these. Oh, sorry, my mistake. Just give me a moment. I will make this appear clean. Now it looks better. My base case NPV is 918.95. Okay. Now, with that in mind, see if I round it off, my answer starts becoming a little more. My answer will be different because of the rounding off of my discounting factor. Now I have to calculate my adjusted present value. This is the main part of the question actually. Statement of adjusted present value. Okay. Base case NPV. This. Now, I have to consider issue cost of debt. I have to consider tax saving on interest, and I have to consider the present value of cheap loan. Now, first of all, issue cost of debt. Okay. Now, there's one line here which I had marked, and I'll tell you why it is so important. I'm using the cheap loan. Issue cost of 4% of gross finance would be payable. Now, normally, the issue cost is has to be funded out of the proceeds of issue itself, which is why in a lot of questions you will find yourself grossing up the amount. In this case, total funds needed are a particular number. How much money do you need? You need 30,600. Issue cost is issue cost will have to be calculated, but this issue cost has been paid how? This issue cost would be paid out of available cash reserves. Okay, the issue cost is paid out of available cash reserves. So I'm not going to explicitly raise that money from the borrow. I'm not going to raise that money at the time of issue. Say at the total amount that I need is 30,600. So if I'm raising 30,600, my issue cost will be 4%. Okay, my issue cost will be 4% and that will be included in the calculation. Now, see, I'm in questions. What usually happens is if say for example I need 100 rupees, then I have to do a back working. I have to gross up the amount and calculate the issue cost because issue cost is paid out of the proceeds of issue. Here, issue cost is paid out of available cash reserves. Okay, so working note 5, issue cost. Total funds needed 30,600. Issue costs have to be, or issue costs are paid out of available cash reserves of the company. You are not supposed to gross up the value to arrive at issue cost. In such cases, the issue costs have to be funded out of the proceeds of issue. यहाँ पे you are not supposed to do that. Okay. Issue costs are paid out of available cash reserves. So issue cost of 4%, matlab your 30,600, which is your total amount, 30,600 into 4% is how you would calculate. Okay. 30,600 into 4%, which becomes basically 1224, and this will be the amount of issue cost paid from your available cash reserves. Normally what you would do is you would gross it up. Okay, you would divide this by 96%, you would arrive at 31,875, and in that case you would say ki, oh, my issue cost is 1275. Not the case here. Issue cost is paid out of available cash reserves. I would say I would add some information here. This happens in cases where the issue cost has to be funded out of proceeds of the issue. Okay, so here I'm going to write down less issue cost minus 1224. Okay. Now I have to calculate the tax saving on my loan. Correct? I have to calculate the tax saving on interest. So what is the risk in this question? If you observe, I'm going for the cheap loan, right? And my rate of interest risk-free rate is 2.5%, but I am getting the loan at 30 basis points below the risk-free rate. That means I am getting the loan at 2.2%. Okay. If I'm getting the loan at 2.2%, then the total amount of subsidized loan that I have raised is 30,600 into 2.2%. I will arrive at the interest amount, and on that I'll have to calculate the amount of tax saving. Okay. So working note 6, tax saving on interest. Now, risk-free rate of borrowing 2.5%. Company can borrow 30 basis points below this rate. ठीक है. So company's rate of borrowing would be 2.5% minus 0.3%, which is basically a rate of 2.2%. Okay. Now, what is the amount of loan? The amount of loan is 30,600. So, the interest at the rate of 2.2% would be this into 2.2%, which is 673.2. Now, this interest will be incurred each year for 4 years. Okay. And this interest will be incurred each year for 4 years, point one. And then of course there will have to be tax saving on this. So what is tax saving? At the rate of 30%. Tax saving at the rate of 30%, which is this into 30%, 201.96. Now, I can decide to, now I'll have to calculate the present value of tax saving. Present value of tax saving. Now, how exactly is this going to be calculated? Please pay attention. 201.96 into annuity factor for 4 years at the rate of 2.5% into discounting factor for T1 at the rate of 2.5%. Annuity factor is 201.96 into 3.7620 into 0.976. How much will this be? Into 3.7620 into 0.976. 741.54. This is the present value of tax saving. Now, something for you to keep in mind in all APV questions. In an APV question for discounting the financing cash flows, you have two options. Either use the risk-free rate or use the rate of interest on the normal loans. Okay. In most ACCA exam questions, they have used the risk-free rate. In some cases, in the exam kit, they have also discounted using the interest rate on normal loans. Remember, whichever rate you use, disclose that fact and you will get full marks. You will not lose marks even if instead of risk-free rate, you use the rate of interest on the nominal loan. So keep that in mind. What is the present value of tax saving? Add present value of tax saving on loan 741.54. Okay. Now, we are only left with one thing. We are left with the present value of cheap loan. Okay. Working note 7, present value of cheap loan. Now, those of you who have studied with me, you know our 8-step approach. So we are just going to follow the 8-step approach. Interest using the regular rate. What is the regular rate? यहाँ पे देखो, regular rate of interest for the company is 5%, which is Tippletine company's normal rate of borrowing. Okay, so 30,600 into 5%. And what is interest using the subsidized rate? Interest using the subsidized rate is 30,600 into 2.2%. Okay. What is the saving in interest cost? 856.28. What is the present value of saving? Again, same approach that you chose here. 856.8. This into 3.762 into 0.976. Okay, you get the present value of saving of interest cost, which is 3145.92. What is tax saving on regular interest? This into 30%. Okay, then, oh, sorry, huh? Present value of saving in interest cost. This just you don't need to multiply this because this is happening T1 to T4. Huh? My mistake. You don't need to multiply it by this. 3223.28. And tax saving on subsidized, what is the tax saving lost? 257.04. Here, because tax saving happens 1 year in arrears, so 257.04. 257.04 into 3.762 into 0.976. So that is 943.38. And what is the present value of cheap loan? The present value of cheap loan is difference between this and present value of tax saving lost, which is 2279.50. I will add it here. Add present value of cheap loan. 2279.5, and my adjusted present value is base case NPV, issue cost, saving, and present value of cheap loan, which is basically 869.43. Okay, what is this 869.43? This 869.43 is my adjusted present value. Now, of course, we had to consider the, financing side effects and all of that and arrive at the answer. Now, naturally, different books will have different approaches in terms of calculating the tax saving. Some books might have used, instead of, discounting using the 2.5% rate, some books might have used the regular rate of 5% for purpose of discounting. Naturally, their APV will be different. Both approaches are fine, whether you use the risk-free rate for the purpose of discounting the financing side effect, or whether you use the regular rate of interest on regular loan, the final answer remains the same. The theory part to this question we are going to discuss separately. For those of you who want the Excel sheet, you can leave a comment below the video and I'll help you with the Excel notes as well. Thank you.